Today on Real Estate Backstage, the fight between NAR and the Phoenix Association of REALTORS heats up, with NAR threatening to revoke Phoenix's charter. The injunction against the Corporate Transparency Act was removed, but then put back in place. The CFPB has filed a lawsuit against Rocket Homes for alleged violations of RESPA. And finally, we'll take a look at one really important economic indicator that almost no one is talking about. Now, before we jump in, if you're watching this on YouTube or if you're listening on Apple Podcasts or Spotify, make sure to subscribe to the show. That way you don't miss any future episodes. And you can find a link to the show notes today with links to all the articles that we're going to reference at realestatebackstage.com/episode 11. Now, I want to start with this battle between the National Association of Realtors and Phoenix Realtors out in Arizona. So last week on the show, on episode 10, we covered the cease and desist letter that NAR sent to Phoenix Realtors over their quote-unquote MLS Choice membership option. Now, this is essentially a scaled-back membership available to local real estate agents in Phoenix who don't wish to be affiliated with the state or National Realtor Association, but still want access to the MLS, to legal forums, and some other benefits as well. So this is according to Real Estate News. The National Association of Realtors has made the difficult but necessary decision to initiate the charter revocation process against Phoenix Realtors, according to an email sent to leaders. Mucho laid out the charter revocation process in her email. NAR President Kevin Sears will ask Phoenix Realtors to review its reasons for noncompliance before a panel of 3 to 5 members of NAR's executive committee appointed by Sears. If PAR fails to convince the panel, it will be given another deadline to shut down MLS Choice. If it does not comply by the deadline, PAR will face a show cause hearing before 7 to 9 different members of the executive committee. If that panel decides to revoke the charter, that recommendation will go before the full executive committee, which will make the final call. PAR's territory would become unassigned and available if its charter is revoked. NAR said that as this process unfolds, it will reach out to local members and make sure they know what's going on and the options available to them, including choosing another local association, Muchow said in her email, unquote. So first of all, just reading that whole process of what it takes for NAR to revoke a charter, there's like 3 different hearings, apparently. You go to a select committee and then a portion of the executive committee and then the full executive committee. I think this is just an example of how bloated and political and bureaucratic NAR has become. The fact that things take this long to get done is a little ridiculous. So it looks like we've got a bit of a stalemate here. Phoenix Realtors does not seem to be backing down. Neither is NAR. I'm curious to hear from you guys. What do you think about this? Drop a comment below if you're watching this on YouTube. Do you think Phoenix Realtors is justified in offering a membership option that is not tied to the state and local realtor association? Or do you feel like NAR is in the right here by enforcing their 3-way agreement? All right, I want to touch on the latest news here with the Corporate Transparency Act. I feel like this has just been back and forth all week long. So a few weeks ago, back on episode 8, we covered the injunction that was placed on the enforcement of the Corporate Transparency Act by a district court over in Texas that temporarily froze the legal requirement for anyone who has ownership interest in a private company like an LLC or an S-Corp from having to file a BOI, Beneficial Ownership Information Report, with the Treasury Department. Well, on Monday, December 23rd, 2 days before Christmas, that law was reinstated on appeal. So according to scorp.org, quote, an appellate court today ruled in favor of the federal government in the reversing of a nationwide injunction against the Corporate Transparency Act. The decision means that the CTA's reporting requirements are now back in full effect, giving the approximately 20 million entities who have not yet submitted their filings just a few days to do so. The injunction that's currently in place was ordered by a Texas court, which found that the CTA is, quote, likely unconstitutional, and that Congress went beyond its authority in enacting the statute. The government quickly requested that the injunction be stayed pending a final ruling, unquote. So that was 2 days before Christmas. The injunction was removed, and the legal requirement that you have to file your BOI report was put back in place. So the original deadline for businesses to file this report was the end of the year, by January 1st. However, with the injunction being put in place and then being removed, that deadline was kicked back to January 13th of 2025. However, in a surprising turn of events, actually today, the day I'm recording this, Friday, December 27th, the injunction was put back in place by the U.S. Court of Appeals for the Fifth Circuit. So this is according to the National Federation of Independent Business. Quote, the court's latest decision reinstates the nationwide injunction, blocking the burdensome beneficial ownership information reporting requirements for small businesses, while the court fully considers the government's appeal. It also nullifies a previous Fifth Circuit order that allowed the government to begin enforcing the CTA and BOI reporting requirements again. The court's reinstatement of the nationwide injunction is a welcome sigh of relief for small businesses, said Rob Smith, senior attorney for NFIB's Small Business Legal Center. Since being told earlier this week that they must urgently submit their BOI reports, our nation's small businesses have experienced enormous chaos and confusion. Thankfully, the court's latest decision recognizes that the CTA and BOI reporting requirements pose serious constitutional questions. It also provides Main Streets across the country with a reprieve from this harmful mandate while our lawsuit proceeds, unquote. So, like I said, I'm recording this on Friday the 27th. This episode is going to come out on Monday the 30th, and who knows, at this rate, by then, we may have another update. Maybe the injunction will be removed again. Hopefully not. All right, shifting gears. So the CFPB, the Consumer Financial Protection Bureau, has filed a big lawsuit against Rocket Homes and a long list of other affiliated defendants. So this is according to Housing Wire. Quote, the Consumer Financial Protection Bureau filed a lawsuit Monday accusing Rocket Homes of orchestrating a kickback scheme to funnel business to its sister companies, Rocket Mortgage and Amrock. The Jason Mitchell Group is also implicated in the alleged violations of the Real Estate Settlement Procedures Act. According to the CFPB, between 2019 and 2024, real estate brokerage firm Rocket Homes purportedly incentivized real estate brokers and agents with referrals and priority for future referrals in exchange for steering clients towards mortgage lender Rocket Mortgage and settlement firm Amrock, which are also under the umbrella of Detroit-based Rocket companies. The Jason Mitchell Group and its founder, Jason Mitchell, allegedly participated by referring thousands of clients to Rocket's companies. Rocket allegedly restricted brokers and agents from sharing competing lenders' information, including details about down payment assistance programs. At the Jason Mitchell Group, agents were supposedly trained to suggest transactions could fail if clients shopped around for other mortgage options. Rocket engaged in a kickback scheme that discouraged home buyers from comparison shopping and getting the best deal, CFPB Director Rohit Chopra said in a statement. At a time when homeownership feels out of reach for so many, companies should not illegally block competition in ways that drive up the cost of housing, unquote. All right, so this is the actual complaint filed by the CFPB. I've got some sections here highlighted that I want to go over with you guys. So just reading right from the document here, and this will be included in the show notes. So again, you can go to realestatebackstage.com/episode 11, get a copy of this for yourself if you want to read through the entire complaint. But like I said, I've highlighted the portions here that I think are really most interesting. All right, so from the document, quote, buying a home can be one of the largest and most consequential decisions in many consumers' lives. As part of that process, consumers often rely on the advice of their real estate agent. Real estate agents should make referrals and recommendations to their clients based on their professional judgment and in sole consideration of their client's best interest. I 100% agree with that statement. But when real estate agents accept things of value in exchange for referring their clients to a provider of other services, it corrupts the real estate agent's relationship with their clients and taints their advice. Congress therefore enacted the Real Estate Settlement Procedures Act, or RESPA, to, among other things, prohibit real estate agents from accepting things of value in exchange for referring their clients to particular settlement service providers, including mortgage lenders and providers of title, escrow, and closing services. Rocket Homes operates a large referral network which matches consumers interested in buying a home with a real estate brokerage working in the local area of the consumer's home buying search. Rocket Homes' referral fee is typically calculated as 35% of the brokerage's commission. But Rocket Homes requires the real estate agents and brokers who receive its referrals to steer consumers to its affiliate company, Rocket Mortgage. So Rocket Homes, Rocket Mortgage, and others, they're all owned by this parent company called Rocket Companies. Essentially, you've all heard of Rocket Mortgage before. Well, they have this sister company called Rocket Homes that is legally licensed as a real estate brokerage. And they have this referral network where they capture leads through their various web assets, and then they refer these potential buyers and sellers to real estate agents across the country for typically a 35% referral fee. And now, apparently, as part of this process, in order to get these referrals and continue getting these referrals from Rocket Homes, you had to agree, allegedly, according to the complaint, you had to agree to steer consumers towards Rocket Mortgage, this affiliate company. All right, let's keep reading. So they had to agree to steer consumers to its affiliate company, Rocket Mortgage, and away from potential competitors, and to refrain from mentioning the value of comparison shopping for mortgage loans or discussing various programs or options not offered by Rocket Mortgage. This, quote, preserve and protect requirement that Rocket Homes pushed on real estate agents undermined the duties the agents owed to their clients. For example, some agents receiving Rocket Homes referrals were reluctant to mention certain options to their clients, including first-time homebuyer down payment assistance programs, USDA loans, and loans on manufactured housing, because Rocket Mortgage didn't offer these options. And some real estate agents actively steered their clients away from comparison shopping Rocket Mortgage with other lenders. All right, Rocket Homes, in turn, gave priority for future referrals from its referral network to those real estate brokers and agents who made their own referrals to Rocket Mortgage and Amrock. All right, Section 40, real estate brokers and agents must agree to Rocket Homes terms and conditions before they can receive referrals from Rocket Homes. One of Rocket Homes' terms and conditions required real estate brokers and agents to steer their clients into using Rocket Mortgage to finance their home. The 2019 version of Rocket Homes Terms and Conditions included a section called Preserve and Protect the Referral Source Relationship. The section told real estate brokers that, quote, as a broker in our network, it is important to preserve and protect the relationship between the client and their chosen lender, Quicken Loans, aka Rocket Mortgage. That section also provided that, quote, the broker agrees that he or she and his or her partner agents will educate themselves and the client on the benefits of using Quicken Loans and other Rock family of companies' services. Finally, the section included a warning that, quote, purposefully steering a client from Quicken Loans to another mortgage lender is prohibited and could result in termination of the broker's relationship with Rocket Homes, unquote. So this can be a little bit confusing here if you don't know the history of it. So Rock family of companies, that was formerly the parent company. Now it's called Rocket Companies. Rocket Mortgage, formerly known as Quicken Loans. So again, this is from the 2019 version of the terms and conditions for the referral network. All right, continuing, quote, Rocket Homes compiled statistics to measure individual real estate brokerages and agents' Quicken Loans conversion rates. Rocket Homes used these statistics to allocate referrals to the brokers and agents who are most successful at steering their clients to Rocket Mortgage. So if you're an agent receiving these referrals from Rocket Homes, apparently the higher percentage of those clients of yours ended up using Rocket Mortgage, the affiliate company, the more likely you were to continue getting more referrals from Rocket Homes in the future. Rocket Homes was very focused on ensuring that real estate agents didn't refer consumers to competing lenders because the Rocket companies made significantly more money on the mortgage origination and servicing fees paid to Rocket Mortgage than from the referral fee paid to Rocket Homes. All right, skipping down to Section 49. Rocket Homes also frequently reminded real estate agents and brokers of their obligation to steer consumers to Rocket Mortgage. When assigning each individual referral, Rocket Homes sent the agent or broker a, quote, client profile and referral agreement. This document warned that, quote, Rocket Mortgage is the client's chosen lender. Any purposeful steering away from Rocket Mortgage is prohibited. Rocket Homes threatened, suspended, and sometimes removed real estate agents that didn't adequately steer their clients away from other mortgage lenders. This included reprimanding a real estate agent whose client complained about Rocket Mortgage's rates and fees seeming high, and the agent then suggesting the client get a second opinion from a local lender. Rocket Homes also punished real estate agents who helped their clients obtain down payment assistance if Rocket Mortgage didn't participate in those programs. For example, Rocket Homes punished a real estate agent for setting their client up with a local lender who obtained $15,000 in down payment assistance from the Tennessee Housing Development Agency. Rocket Mortgage didn't participate in the THDA program at the time. Rocket Homes also repeatedly pressured real estate brokerages to hit a capture rate of 80%. This meant that of the Rocket Homes consumers who were referred to a real estate brokerage and ended up buying a home, Rocket Homes wanted at least 80% of those consumers to get their mortgage from Rocket Mortgage. So this is definitely one that we're going to keep an eye on as the story develops, but this could be a pretty big RESPA enforcement action by the CFPB. All right, so I want to wrap up by talking about jobless claims. Now, this is one of those economic data points that is really, really important, but we really don't hear it covered very often in the news. So according to Reuters, quote, the number of Americans filing new applications for jobless benefits dipped to the lowest in a month last week, consistent with a cooling but still healthy U.S. labor market that is likely to keep Federal Reserve officials from cutting interest rates any further in the near term. Initial claims for state unemployment benefits fell by 1,000 to a seasonally adjusted 219,000 for the week ended December 21, the Labor Department said on Thursday. Economists polled by Reuters had forecast 224,000 claims for the latest week, unquote. So I'm going to put some graphs up here on the screen for you guys that are watching this on YouTube. If you're listening on Apple Podcasts or Spotify, I'm sorry, there's no way for me to get these graphs in your earbuds, so you're just going to have to go onto YouTube and watch it. All right, so this is basically the long-term trend of initial jobless claims. And I wanted to show this really long-term graph just so you can see how crazy it was in March of 2020 when basically the whole world shut down due to COVID. Look at that, over 6 million initial weekly jobless claims. That is just absolutely insane. But with that really big spike there, it makes it really, really hard to discern any of the other data points. So I've got a new graph here that I pulled just from like the early 1980s through very, very, very early 2020, right before COVID. So you can kind of see the last like 3 to 4 recession cycles of what those initial weekly jobless claims looked like. So for example, if we look at the 1990 recession, right when that hit, we were at about 364,000 initial weekly jobless claims. In 2001, during that, when that recession started, we were at 393,000. In 2007, 2008, at the beginning of the financial crisis, we saw 355,000 initial weekly jobless claims. So the last 3 recessions, not counting the 2020 recession for COVID, looking at 1990, 2001, and then 2008, we've got 364,000, 393,000, and then 355,000 for weekly initial jobless claims. Now look at what's happened since COVID. So ever since we recovered from that crazy, very, very strong, very, very short recession in 2020, the most recent data that we have from last week is 219,000 initial weekly jobless claims. So even though that number has been slowly trending up over the last couple of years, it is still relatively very low. If you go back and look at even the low points for initial claims in between these recessionary cycles, from the 1980s to 2020, you can see that it was rare to get below 300,000. Anything below 300,000 was a really low number for initial claims. We have not gotten back above 300,000 since COVID. So right now we're at 219,000 most recent reading. So even though the unemployment rate is going up, even though the rate of job growth is slowing, this is something that you really need to keep an eye on, the initial weekly jobless claims, because this is showing you the people that are out of work, filing for unemployment benefits. This is a really, really good leading indicator. If we see this number get above 300,000, I mean, really even that wouldn't necessarily be cause for alarm. Historically speaking, it would have to be, over 350,000 to really indicate that we're about to head into a recession. So just something to keep an eye on. All right, y'all, that's a wrap for today. Just a reminder, you can find the show notes with links to all of the articles at realestatebackstage.com/episode 11. And I'll see you guys here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.